Okay, thank you very much. And thank you very much to Eric and Andrew for setting the scene. So I'm going to talk about something a lot more specific. So you've set the big picture, and now I'm going to largely talk about an insurance product which helps address some of these long-term costs. So I'm going to talk about three things. And the first one is, why do we have a session on long-term care insurance in a pensions conference? So what's the relationship between long-term care costs and pensions? And then secondly, I'm going to talk about a study that we did where we explored the stated preferences for a particular type of long-term care insurance product. And in doing so, I need to acknowledge my co-authors in that study, Shang Wu, Susan Thorpe and Ralph Stevens. And then the last thing I'm going to do is discuss the implications of this study and some practical applications of introducing such an insurance product in the market. So, why do we have a session on long-term care in a pensions conference? Well, if we think of pensions policy, we often look at pension products and look at the extent to which they address longevity risk, market risk, inflation risk. But we probably don't think about long-term care risk. But as we know, long-term care has high prevalence. 3 in 5 of us will need long-term care at some stage of our life, and potentially has high costs. Now, in the absence of effective insurance markets, people tend to insure for long-term care. And that's compromising our financial well-being in retirement. Many countries have set up retirement savings schemes. In Australia, for example, we have a compulsory defined contribution scheme. But we see that people are self-insuring for long-term care, and there's a reluctance to draw down their retirement savings. We don't have compulsory annuitisation, and people are reluctant to draw down both their retirement savings and their other household assets, such as their housing. We also have a voluntary annuity market, and similarly, people have a reluctance to buy retirement insurance products because they're self-insuring for long-term care expenses. Now, in thinking about an insurance market for long-term care, another sort of spanner in the works is that people have a preference for ageing in place, but ageing in place using informal care. And informal care is not covered by a typical long-term care insurance product. Here, we also see that there's significant costs to informal carers. So informal carers will often stop working, work lower hours, get lower income, get smaller pensions. And so we see here the relationship between sort of providing for long-term care and pensions. It's an inverse relationship at the moment. And if we look at informal care in Australia, currently around 10% of the population over 65 are informal carers, and mostly these are spouses and daughters. So just looking again at people's precautionary savings to save for long-term care. A few years ago, I was involved in a study where we looked at Dutch and Australian pre-retirees, and we wanted to find out why they would be likely to continue to save or not draw down their retirement assets in retirement. One of the most important things was health and aged care expenses. And this is interesting in the Netherlands because according to the OECD, the Netherlands has the highest public expenditure on long-term care in the OECD. And yet the Dutch themselves are not spending down their pensions because they're concerned about long-term care costs. So what's one possible solution? Well, one possible solution is an insurance product which will address or help people with informal care costs. And the product I'm talking about here is a type of life care annuity, and we call it a long-term care insurance income product. And so the product that I'm going to be talking about in my study is there's a single premium at purchase, and you receive that this product has a trigger such that if you fail 2 ADLs or you're cognitively impaired, you receive this payment. And this product will pay a regular income in the period of need. And you can use this income however you like. So it's not an expense reimbursement product. You can use this income to pay for formal care or informal care. So you can use it to reimburse or compensate informal carers. A number of life cycle models show that access to this product is a welfare improving. And a similar type of product is now one of the fastest growing annuity products in the US. So 80% of new sales of long-term care insurance is this annuity with a long-term care rider. So I'm just going to talk a little bit about the stated demand experiment that we undertook. And what we were interested in here is that if such a product existed, who would buy this product and how much would they buy? And really we were looking at, would people who wanted to age in place and use informal care, would these be the people who would buy this product? And another thing we were interested in is if people had access to this product, would it cause them to release precautionary savings and purchase longevity insurance? So rather than self-insuring, if they could actually insure against long-term care, would they release their precautionary savings? Very quickly, I'll talk about the study. So we had a representative sample of 1,000 Australians, pre-retirees aged 55 to 64. And we asked them to complete a sequence of choice experiments where they could choose effectively between putting their retirement savings in a life annuity, our long-term care insurance product, or an investment account, which is a phased withdrawal product. In Australia, we call it an account-based pension. And then as we do in these studies, we collected lots of information about people. So we collected their demographics, we collected their preferences, we collected their knowledge of the products, of financial literacy, their self-assessed need for home and residential care, and whether they had available to them informal care for either low-level care and or high-level care. Okay, and I've just got a picture here of one of the choice tasks. So typically in these experiments, we don't just throw people in at the deep end. We teach them about the risks they may face in retirement. We teach them about the products. We incentivize them to learn about the products by paying them an incentive payment. At the end of the experiment, we tested them on the products and we told them that we would give them an incentive payment if they did well in the test. And then we asked them a series of choice questions where we asked them to choose a certain amount of long-term care insurance. And we led them through a number of questions, and these questions told us whether people would buy the product, how much they would buy of the product. And also we had a number of questions which allowed us to find out whether long-term care insurance and annuities were substitutes or complements. So we could find out whether if people had access to this product, they would release precautionary savings and buy longevity insurance. So what did we find? Well, we found that around 75% of our sample would purchase some of this product. And I know you see 75% and you say, well, that's unreasonably high. But what you have to remember in these stated choice experiments is we assume away the distribution network. We're basically putting people in front of the product. We're teaching about the product. We're making them aware of the product. They understand how the product works. And so we're getting rid of a lot of the barriers in the real world that are preventing people to buy these sorts of products. What we found was that there was very strong demand for this product, particularly amongst people for whom who wanted to use informal care and had access to informal care. So for example, both males and females who have access to high-level informal care demanded 25 to 37% more of this product than people who didn't. Females in particular, who expected to rely exclusively on high-level care from family members, were willing to buy more than males, and females with children demanded significantly more of this product than females without children. We didn't get this effect for males. And if females had bequest intentions, we didn't get this effect either. And so, what our study is showing is the sort of people you would expect to demand this product actually did demand this product in our experiment and did demand more of it. We also found that when people had access to this product, for a large minority of people, this product was a complement to a life annuity. And so for around 32% of our sample, the life annuity and this long-term care insurance were complements. So access to this long-term care product released precautionary savings for people to buy life annuities. And so just sort of summing up on our experiment, what have we found that sort of helps us understand or improve the relationship between long-term care costs and pensions? Well, we find that this sort of product has a complementarity with informal care. So our long-term care income product attracts people who prefer informal care and who want to support and compensate their carers. And so to some extent, that's going to help the carers. The carers are not going to fall behind as much in their pension savings. There's also complementarity with longevity insurance. So access to this product is allowing the release of precautionary savings for people to purchase annuities. And this is really important in voluntary annuity markets. So what are some practical implications of this sort of product? Well, quite clearly, this product doesn't cover catastrophic risk. But as we just heard from Andrew, catastrophic risk is something that should be covered by the public sector. And so this is maybe one of the innovative products, hopefully, that Andrew is talking about, that would be suitable to supplement public systems which do provide cover for catastrophic risk. Australia, to some extent, because we have a lifetime cap on individual contributions to care. In Australia, individuals have to pay some of the regular contributions and the accommodation costs, but there is a lifetime cap on the means-tested contributions. So to some extent, this product provides a good complement to the system that we have in Australia. Even if this product existed, there'd be many barriers to take up. I mean, as we know, we have a voluntary annuity market, but people don't buy annuities. So if this product did exist in Australia or other countries, there'd need to be a lot of effort, probably both from government and private providers, to make sure that people were aware of the product, people understood the product, and there was effective product distribution. An additional challenge would be to get CEDIAs to actually spend the money. So even if people bought this product and they received income payments for which they could compensate informal carers, a challenge that we've had everywhere is to get the elderly to spend their money. And so the Dutch, for example, they receive pensions rather than lump sums or phased withdrawal products, and they are reluctant to spend from their pensions. So people need to be encouraged to actually spend this money. And then I guess another issue we have as people get older and move into cognitive decline, we probably have to be careful with a product that's going to give these older people income. And so we have to have some checks and balances there. So that's all I have to say about a new type of product, which will both help individuals manage their retirement risks and also help the carers, who many of them go uncompensated and have significant sort of implications for their labour market experience and pensions. So thank you.